Hi, everybody, and welcome to a fresh new episode of our Made for YouTube series. I'm Sumera Abdi, and today we want to talk about aggressive hybrid funds. So, basically, aggressive hybrid funds are one of the schemes in the hybrid category. And over here, SEBI says that there must be a 65 to 80% allocation to equity and a minimum of 20% allocation to debt, which can be scaled up to 35%. So, joining in today to talk about is Ashish Nayak, who's the equity fund manager at Axis Mutual Fund. Hi, Ashish. But before we get chatting,
Hi.
just a fun fact for those who are watching: did you know that an AMC can offer either an aggressive hybrid fund or a balanced hybrid fund? So, balanced hybrid fund basically has similar allocation to equity and debt. They cannot offer both. They must make the choice. So, Axis has made that choice. So, that's exactly where we want to begin. Ashish, why did you choose to go with
Sure.
an aggressive hybrid fund and not a balanced one?
Sure. Thank you for the question and thank you for having us here. So yes, I mean, absolutely. Just before we go into the details of why we chose aggressive hybrid, a clear differential between the two is that the aggressive hybrid fund can invest about 65 to 80% into equity and equity related instruments and remaining in debt instruments. For the balanced fund, it is about 40 to 60% in equity and equity related instruments. Now, we believe that as an asset allocation where equity exposure is on the higher side, gives the investor to opportunity to participate within the a higher growth story that is India from a long-term perspective. So at least for the next 10 to 20 years, we see India is quite well placed, and hence having higher exposure to equity in such a kind of fund actually makes more sense. At the same time, the fund gives you optionality of protecting the downside by going up to 35% in fixed income securities. So to that extent, obviously, the benefit of diversification can be had, and hence there is downside protection also available. The third thing, and which is much more important, is from a taxation perspective. Is that because 65% of the fund is at least invested into equity and equity related instruments, the taxation for aggressive hybrid fund is as an equity fund, versus that the balance fund does not get that benefit. So overall, that these three factors are the reason why we have chosen aggressive hybrid fund to over balanced fund from a investor perspective.
By the way, for everybody who's listening in, don't confuse the balanced hybrid with the balanced advantage fund. That's another category within the hybrid space. But Ashish, what kind of an investor would this be suited for? Because if somebody is looking at, having,
Mhm.
predominant equity exposure, why wouldn't they go with a pure equity fund, or for that matter, even the balanced advantage or a dynamic fund?
Sure.
What is the
Mhm.
peculiarity of an aggressive hybrid which scores over the others?
Correct. Absolutely. So again, this fund is targeted for investors who have some exposure to how the capital markets work. At the second time, the fund is also targeted for investors who want a decent exposure to equities, but are slightly afraid of something going wrong. This fund can be looked at as a precursor for pure equity investing from an investor perspective, and especially from an advisor perspective. And if an investor actually becomes comfortable, with the aggressive hybrid fund, then in most cases they will be able to withstand the volatility of a large cap or a multi cap fund.
Okay. So, what is the orientation of the equity and the debt portions? I mean, would the equity in this kind of a fund be largely, say, large cap?
Yes. So absolutely, from having the strategy of this fund, we have been very clear that safety is of paramount importance for the investor, and this is actually reflected both in our equity as well as the debt side of the investment. So, as you mentioned rightly, on the equity side, we are a large cap oriented strategy, where about 80 to 85% of the fund currently is in large caps. And even on the mid cap side, we have been very selective in terms of the exposure, in terms of having steady compounders, companies with a performance track record, and a stable business model. On the debt side, again, it's active allocation, but at this point of time, we are lower on duration, and we continue to deploy our barbell strategy of having high quality bonds as well as low duration assets in terms of credits also. And that's a play on the carry theme. credits we believe are actually a good investment option for somebody for an investor who's looking for a 3 to 5 year investment horizon, given that the economic cycle recovery as well as the liquidity situation being comfortable assuages some of the credit risk, especially in high quality names.
Yeah, I know. Actually, I think we had spoken to Shivakumar maybe I
Sure.
think as long back as a year ago, when he said that you can start re-looking at credit again. But in this clearly, and by the way, for those who are watching, don't get intimidated just because it's called aggressive, as you heard Ashish. That it's pretty tame in terms of the allocation. It's just that compared to the other strategy, this is mostly equity, and which is why the name aggressive.
Mm-hmm.
But over here, the emphasis of hybrid funds is clearly on downside protection, right? For investors who are looking for that. Otherwise, in any case, they could have opted for an equity
Sure.
strategy. So, is that the most important criteria, or would the consistency of returns also matter to an investor here? And because it's
Absolutely.
it's a hybrid fund, I'm assuming that by and large, all the aggressive hybrid funds would be large cap oriented. So therefore, how would an investor differentiate one fund from another?
Right. So I think at Axis, one of the clear process and one of the clear beliefs that we have is that wealth preservation is much more important than wealth creation. If we are actually able to protect the downside, then participating in the market upside becomes much more easier. So let me give you an example here. If you consider, any fund that, let's say, falls about 20% in a market fall, to recover to its initial corpus, it just needs returns of 25%. Now, on the other side, if the fund actually falls by 30%, then to come back to its initial corpus, the return that is required is about 43%. So you can really understand that just by not falling much in the down and having downside protection, that actually can be a derivative of consistent returns. So in summary, what I would say is the lower the downside probability, higher is the chance of positive returns and hence overall consistency of the fund performance. So I think that is what the clear focus of Axis in terms of having wealth preservation over wealth creation becomes a differentiator across our funds, including the hybrid funds and aggressive hybrid funds.
Okay. Is there an ideal time horizon which an investor needs for the aggressive hybrid scheme to show its optimal performance, and what kind of goals would you say are best served by this kind of a scheme?
Sure. So given that major portion of this fund is equity oriented, we would suggest investors to stay invested at minimum of 3 years. Obviously, there can be intermittent volatility in the middle, and hence having 3 year time horizon minimum ensures that we tide over these kind of volatility successfully. Also, from a goal perspective, aggressive hybrid fund is a good solution for somebody who's looking for it as a mid to long term goals to be targeted. And we say this because a major source of the returns will be from equities, which are about 65 to 80% of the overall corpus.
Okay. Ashish, if an investor has already invested in the aggressive hybrid, what kind of other funds would sort of be complementary in nature? I mean, would you? I mean, my guess would be that you wouldn't need another large cap fund, right? If you put this at the core, what other kind of diversified fund, or maybe something like a flexi cap? What would an investor need to augment this?
Right. So as I said earlier, having comfort with the volatility of an aggressive hybrid fund will eventually make the investor more comfortable to withstand volatility of a large cap or a flexi cap fund, given that that's going to be a pure equity exposure. And obviously, we have seen market timings where even in a month, the market can correct more than 5-10%. Now, people who have a huge corpus of their investments, let's say from steady income, which is in the earlier stages of their life or the middle stages of their life, they will eventually want to have something more, aggressive, something which can actually give them higher returns that can beat inflation over a longer period of time. On the other side, if we look at somebody who is near to retirement and probably looking at having a stable savings for post-retirement life, will probably not want to take higher exposure, and hence, from a investment perspective on the hybrid fund space, should ideally start looking at something like a conservative hybrid fund, to actually preserve their assets rather than trying to participate in the upside from equity markets.
Okay, so when somebody is looking to invest in aggressive hybrid, or say they have already invested, what would be the 2 or 3 top things maybe they should look at reviewing regularly? Maybe if they're looking at the fact sheet, what would be the top 2 or 3 things that an investor must know or keep a check on regularly?
Absolutely. So it's very important that the fund sticks to whatever ideology that they have spoken about. So obviously, when they look at the kind of stocks that are there in the equity portion, that will become important in terms of the spectrum of large cap, mid cap, and small cap. They would have put out there that this is going to be the strategy. Are they really sticking to it on a month-to-month basis? And more importantly, obviously the overall allocation of equity versus debt, is it really varying too much, that they are trying to take too much calls on the market volatility and trying to outsmart markets maybe by timing it. Something might not really work at all the time. So obviously that's something that can also be looked at. From a debt perspective, again, it's important to see the kind of credits, the kind of companies that they are holding, if it's not a GSEC. And to that extent, obviously, if there is too much of dependency on low quality, high yield kind of stories, then it's something that might have to be sort of relooked in terms of the fund being highly volatile for the investor.
Yeah, that's in fact something that holds true across the spectrum, right? Not just for this category.
Absolutely.
Thanks very much, Ashish, for joining in and for explaining this to our viewers.
Pleasure. Thank you.
Thank you. I hope everybody who's watching has benefited from this chat. I hope you've learned something new. And if you have suggestions for any other topics that you'd like us to cover, we look forward to reading all of them. Thanks very much for watching. Stay safe.